Good morning. I'm Jim Stewart. I'm the Chief Investment Officer at Worth Asset Management for Tuesday, June 21st, 2022. Yesterday was a national holiday, Juneteenth, Freedom Day, so the markets were closed. So today we're going to go over the three threes for the week. Starting on Tuesday, we're going to go over our three market movers. We're going to go over our three favorite and least favorite asset classes. And we're going to go how we're positioned, whether we're in protect, add, or growth mode. And we're going to do that on equities, and we're also going to do that on bonds today. So let's begin.
Okay, let's go over the top three market movers for the week. Interest rates. The Fed on Wednesday raised the benchmark interest rate by 75 basis points for the first time in 28 years. This hasn't happened since 1994. And this was all to address the worst inflation that we have seen in 40 years. So I have a picture here of the Fed actually doing its job. Okay, the Fed is trying their hardest to stop this water from running over or stopping this inflation from really hurting. And all they're doing is they're basically duct taping a major issue. And so it would probably been a little bit better had they add a little, but that's kind of where we're at. But okay, on a more serious note, we have to be careful here. While some on the Wall Street kind of cheered this 75 basis point rate hike, equity markets have been collapsing. And for the record, US equity markets have lost $12 trillion this year alone. Now, keep this in mind. This will eventually start affecting GDP because every 10% decline in the S&P 500 has the potential to shave off 1% of real GDP growth. And with 2022 real GDP growth rate coming in about 2.5, 3, a 20 or 30% decline in equities, we're already at 20, this would almost assure that we're headed into a recession. Now, GDP was negative for the first quarter, and it's teetering again, like I said last week, on going negative again for the second quarter. So we will see here in the next probably month or so. Bitcoin. I keep adding it here because here we thought that this was our an alternative to equities, to bonds, to everything. Laser eyes. It was touted as being the next best thing. It fell another 30%, fell below 18,000, and again, just back in November, it was up to 69,000. And Ethereum, Bitcoin's half cousin, fell below 1,000 after trading nearly 5,000 6 months prior. That's an 80% correction. So again, another area that we want to desperately avoid, maybe in the future, but today, absolutely not. Let's go over our top three asset classes. Commodities, US dollars, and T-bills were in the top three last week, so there is no change. The bottom three, again, no change from last week. We still have the NASDAQ, we still have small caps, and we have long treasury bonds. Now, here's a little side note on this. Those three that are in the bottom three were in the top three at some point last year. So they have completely turned and gone the other way. Where they go from here, I don't know, but they're in the bottom three as of today. And so again, we want to avoid them. And again, here's why. Let's take a look. I added a column going over the 2-week performance because the S&P in just in 2 short weeks has gone through a correction and it's down over 10%. So if you look here, even though the commodities had a rough day on Friday, it affected their 2-week down a little bit, down 3%, but the dollar and the T-bills were both positive while the equity market was negative. And you look over here, small cap equities and the NASDAQ and the long bonds, again, all negative for the last week to 2 weeks. But if you zoom out and take a look at it a little bit on a longer term picture, you have the equity markets represented by the SPY at up or down 17%, while commodities, the dollar and the T-bills were all positive. Again, seeking that strength in this market, and that's where it is. And we're avoiding all of this double-digit negative type of returns over this longer-term picture over the last 3 months. Okay, let's one more time look over the position of where we are and how we got here a little bit bigger so you can see this. This is the S&P, and since the bottom of COVID, we've been in growth mode. And then all of a sudden, January 19th, Protect started liquidating some equities. Something's going on, don't want to wait and see. Let's just go ahead and get out. We can always get back in, and the market dropped. Then all of a sudden we were starting to nibble again, thinking that maybe they fixed everything. Well, no, they didn't. April 14th went right back to protect mode, started reducing equities. And from that time to last Friday, the market dropped 16% with a peak to trough drawdown of 20%. Again, not a place that we want to have our clients' assets in on the equity side. Now, let's take a look at bonds. I'm going to zoom out.
Okay, let's take a look at the bonds. Here's a graph of the 10-year Treasury yield. And at the beginning of this year, the 10-year was at 1.55. Through Friday, we're at 3.24, and actually we're up about 5 basis points this morning. So we're actually at 3.29, almost a double in the 10-year Treasury yield. Now, keep in mind, this chart looks absolutely fantastic if you're in equity. But since it's a bond, bonds yields are the inverse to price. So let's take a look at the price. All right. This is a graph of the aggregate bond index. This is the S&P 500 for bonds. This is a big basket of treasuries, of mortgage-backed securities, of agencies, you name it, it's in this aggregate bond index, so it's a good representation for the bond market. Protect mode, January 3rd, we've been selling bonds this whole way down. The bond index is down 11% year to date with a drawdown of 13.5 from peak to trough. So bonds did not protect you, unfortunately. With the equity markets down over 20%, the bond market is down over 11%. So not a lot of safety there. We are in protect mode on equities, and we're also in protect mode on bonds. So I got a few questions to ask. What does your equity and bond allocation look like today? How has it looked throughout 2022? Did you make these changes? Were you going to protect mode on the equity side or the bond side? Was your advisor doing these things for you? We were, for our clients. Because we have an active investment process. Do you have an active investment process, or are you just buying, holding, and hoping, like a lot of people out there are doing right now, and hoping that we were going to reach a bottom, etc. So if you did perchance do these kind of things, when do you start adding and buying again? I've got a lump sum, I'm actually in cash, I'm all of these things. When do we start doing that? Hold that thought, we're going to go over that next week. Thank you for joining us. Again, here's our contact information. Again, next Monday, we will be going over when do we add, when do we buy, and are we at a bottom, or is this just another bottom until we find the actual true bottom for this market on the equity side and on the bond side? Thanks. Please subscribe, like, comment. Again, we do this as an education for our clients and for many of you out there. So we look forward to seeing you next week. Thank you very much.